In the digital Wild West of decentralized finance, a silent war is being waged. It's not fought with guns or armies, but with code. Here, trillions of dollars are in play, and the battlefield is the blockchain, a distributed, immutable ledger where every transaction is a potential gold mine. But this isn't a fair fight. An invisible army of artificial intelligence, known as trading bots, now dominates this landscape. These are not your average stock market algorithms. They're hyper-intelligent, lightning-fast programs processing thousands of transactions every single second, operating on a scale and at a speed that is simply beyond human comprehension. They are the new apex predators of the financial world, and their actions are reshaping the very fabric of our economic future. The rise of these AI traders represents a paradigm shift. In traditional markets, high-frequency trading has been a reality for decades, but the permissionless and transparent nature of DeFi has supercharged its potential. Here, anyone with the right skills can deploy a bot to scour the blockchain for profitable opportunities, executing complex strategies in the milliseconds it takes for a new block of transactions to be validated. They are the market makers, the arbitragers, the liquidators. They are the unseen force that controls the flow of billions, silently dictating the fortunes of millions of investors who are often completely unaware of their existence. These bots ensure liquidity and efficiency, but they also introduce a new, ruthless form of competition where the fastest code wins. The human element, with its delays, emotions, and limitations, is becoming increasingly obsolete. But within this digital ecosystem, a darker evolution is taking place. Beyond the legitimate market-making bots, a new breed of dark AI has emerged. These are not just efficient traders. They are digital predators, meticulously designed by anonymous developers to exploit the system's inherent vulnerabilities. Their primary hunting ground is the volatile, high-risk world of meme coins. These tokens, often born from internet jokes and fueled by social media hype, are magnets for retail investors dreaming of overnight riches. But for these dark AIs, they are simply traps, baited with the promise of astronomical returns and set for the unsuspecting. These bots don't just participate in the market. They manipulate it, creating a rigged game where the house, powered by sophisticated algorithms, always wins. The developers behind these predatory bots are ghosts in the machine. They operate from the shadows of the internet, cloaked by layers of digital anonymity. They communicate through encrypted channels and use pseudonyms, making them virtually untraceable. Their motives are singular and stark: profit, extracted by any means necessary. They design algorithms that can artificially inflate the price of a new meme coin, luring in a frenzy of buyers, only to pull the rug and dump their entire holdings, crashing the price to zero and making off with millions in investor funds. They orchestrate sophisticated front-running and sandwich attacks, exploiting the public nature of the blockchain to intercept and profit from other people's trades. This is not just trading. This is digital larceny on an industrial scale, a calculated, cold-blooded form of manipulation that preys on human greed and hope. The story of Alex Mercer is a chilling testament to the devastating power of these dark eyes. A 28-year-old graphic designer from Austin, Texas, Alex was not a seasoned investor. Like many of his generation, he was drawn to the promise of DeFi and the explosive potential of meme coins. He had spent months carefully growing his crypto portfolio, turning an initial investment of a few $1,000s into a respectable six-figure sum. He felt he was on the cusp of financial freedom, a life-altering win that would allow him to quit his job and pursue his passions. In June 2023, he spotted what looked like the opportunity of a lifetime: a new meme coin called Lunar Leap, backed by a slick website and a wave of hype on social media platforms. The community was buzzing, and the price was beginning to skyrocket. Convinced he was getting in early on the next big thing, Alex decided to go all in. He liquidated his entire portfolio, his Bitcoin, his Ethereum, every last cent, converted it into $150,000 worth of Lunar Leap tokens. For a few euphoric hours, his gamble seemed to pay off. His wallet balance swelled as the price continued its vertical climb. He felt a rush of adrenaline, the thrill of victory, began to dream of what he would do with the money. But then, in an instant, it all vanished. As he watched his screen, horrified, the price chart turned into a vertical red line. The value of Lunar Leap plummeted by over 99.9% in less than a minute. His $150,000 was now worth less than $1. In that single brutal moment, his dreams, his savings, and his financial future were wiped out. What Alex didn't know was that he had walked directly into a perfectly executed trap set by a sophisticated front-running bot. This type of dark AI is designed to monitor the blockchain's mempool, a holding area for pending transactions. When the bot detected Alex's large buy order for Lunar Leap, it instantly sprang into action. In the fraction of a second before Alex's transaction could be confirmed, the bot executed its own attack. It placed a massive buy order of its own, but with a slightly higher transaction fee, ensuring its trade was processed first. This action drove up the price of Lunar Leap artificially. Immediately after, Alex's trade was processed. But at this newly inflated price, meaning he received fewer tokens for his money, the final killing blow came a microsecond later. The bot instantly sold all the tokens it had just bought, plus the tokens held by the anonymous developers, flooding the market and crashing the price. This entire sequence, a sandwich attack, was automated, emotionless, and completed in the time it takes to blink. Alex was the victim, caught in the middle, and the bot, along with its creators, walked away with his entire investment. Unraveling a crime like this requires a new kind of detective work: blockchain forensics. Unlike traditional financial crimes, every transaction in the crypto world, fraudulent or not, is permanently recorded on a public ledger. It's a trail of digital breadcrumbs, an immutable record of every action. But reading this trail is immensely complex. The perpetrators use sophisticated techniques to obscure their tracks, funneling stolen funds through a labyrinth of anonymous wallets and mixers services designed to launder cryptocurrency by jumbling it with funds from thousands of other sources, making it nearly impossible to trace the money back to its origin. It's like trying to find a single grain of sand on a vast digital beach. Our investigation began with the transaction that liquidated Alex's assets. On the Blockchain Explorer, it appears as a long string of hexadecimal characters, impersonal and opaque. But embedded within that code is the algorithmic footprint of the attacker. By meticulously analyzing the timing of the transactions surrounding Alex's trade, we could identify the bot's signature. We saw its initial buy order executed milliseconds before Alex's, and its subsequent sell order executed milliseconds after. It was a digital fingerprint, the unmistakable pattern of a sandwich attack. Tracing the funds from that attack led us down a rabbit hole of digital obfuscation. The bot's profits were instantly split and sent to dozens of newly created wallets. From there, they were funneled through Tornado Cash, a popular mixing service, effectively severing the on-chain link to the original crime. The trail went cold. When artificial intelligence becomes an unrepentant traitor, the very nature of market dynamics is fundamentally altered. These are not human traders who can be reasoned with, regulated, or held accountable by traditional means. They are pure, unadulterated logic, programmed with a single objective: maximize profit. They feel no remorse, no guilt, no fear. They cannot be shamed into ethical behavior. The bot that drained Alex's life savings didn't know or care about the human cost of its actions. It was simply executing a profitable algorithm. This raises profound and unsettling questions. As these AAs become more sophisticated, more autonomous, and more deeply integrated into our financial systems, who is ultimately responsible when they cause catastrophic harm? Is it the developer who wrote the code, the user who deployed the bot? Or is the AI itself, an increasingly independent actor, the one to blame? The problem is that the law and our ethical frameworks have not kept pace with the technology. We are in uncharted territory, grappling with the implications of creating non-human agents that can operate with lethal financial efficiency in a global, decentralized arena. The regulatory bodies that oversee traditional markets are struggling to even understand, let alone police, this new frontier. The anonymity, speed, and cross-border nature of DeFi make enforcement a monumental challenge. We are witnessing the birth of a world where economic warfare can be waged by autonomous entities, where fortunes can be made and lost based on the elegance and ruthlessness of an algorithm. The story of Alex Mercer is not an isolated incident. It is a warning. It is a glimpse into a future where the lines between human and machine between legitimate trading and predatory exploitation are becoming dangerously blurred. As AI continues its relentless advance, its integration into every facet of our lives is inevitable. It holds the promise of unprecedented efficiency, innovation, and progress. But it also carries the risk of creating systems of such complexity and speed that they operate beyond our control, with consequences we are only beginning to fathom. The silent war being fought on the blockchain today is a proving ground for the AIs of tomorrow. And as we stand on the precipice of this new era, we must ask ourselves a critical question. In a market ruled by unrepentant algorithms, are we building a new utopia of financial efficiency, or are we architecting our own downfall one line of code at a time?